Hi there, and welcome to this update for September 5, which is Father's Day. So this will be a little bit briefer this morning, as I'm sure we've all got things to go and do. And the market rally continues. We've had a very strong rally during the week, and it was largely on the back of some seemingly good data in Australia and also some seemingly good data in the US. And I hope I'm not being a bear and only looking for the downside, but when you look behind some of the figures, they really don't hold water, and I can't help thinking that the market's getting a bit overexcited on some superficial numbers and not actually looking at the real numbers behind. For example, in Australia, the GDP numbers were given a great deal of airplay over the week, and Wayne Swan was up there waving a big bunch of papers and saying how great it was, and governments around the world would kill for figures like that. But when you actually look behind them, whilst the Australian GDP number was up, it was predominantly in non-discretionary spending, things like insurance and transport and things that we really don't have a choice to spend our money on. In actual fact, the discretionary spending, which is really an indication of very positive sentiment in the economy, was actually down. So that's just a little bit of a warning signal that things aren't quite as good as they might seem on the surface. In the US, the market certainly propelled forward in the last few days on the basis of some better US jobs numbers, particularly on Friday night. And yes, the employment numbers were a little better, but again, look behind the numbers. Most of those increase in employment figures were largely part-time jobs, and the unemployment figures were worse. And if you look at a number called the U6, which is really the broad-based look at the unemployment situation and includes people that have given up looking for work, which is what the headline number doesn't do, it just ignores those, then in actual fact the US unemployment rate is closer to 16.5%. So just some real caution about getting too excited about these numbers and getting carried away with what the media is saying, because at the end of the day in the US they're a consumer driven economy, and if the consumers are not spending or do not have the spending power, then this economic recovery just does not have legs. Okay, so just before we start, it's general advice only, of course, and this is being presented under the authority of Financial Services of Australia. So let's just have a quick look at some of the normal charts, big picture, just to give us a bit of a look at what's going on. The US dollar index, in fact, fell on Friday. I may have said in the alert this morning that the US dollar rose. The chart I was looking at had not updated properly, so in actual fact the US dollar did decline a little on Friday night. And this is one that may be very significant. The US Treasury market, so the 10-year Treasury notes, where money has been absolutely piling in as a safe haven and therefore creating very, very low long-term interest rates, as you can see, may well have peaked out in the last couple of days, and we had this little congestion area here just above 125, between 125 and 127. Now that little minor support level is broken down on Friday night. It's only preliminary, but if this continues, which everyone was expecting it ultimately would, this was a real bubble that was forming, then what this means is that long-term interest rates will start to rise, and in fact did start to rise on Friday night. And that is seriously bad for the US housing industry and for any possible recovery in the US economic data as well. So just a bit of another warning sign there as well. Natural gas is an opportunity that may present itself. It's been sold off quite heavily in the last few months, from up around about $5.40, got down to a low of $3.70, which, and whilst it doesn't show on this chart, we will have a look on Market Analyst when I swing over there. You'll see that this is really formed a double bottom here, and quite a positive move off this double bottom. So opportunity perhaps to exploit this move in natural gas which may occur over the next few days or few weeks. The bullish percent index chart has turned up by 5%, and so that may be an indication of a more sustainable rally. But as you can see, we saw the same thing happen here in June and again in July, and both times the market failed. So in this kind of very volatile sideways market, this signal may be a little less reliable than it would be in a market that's trended to an extreme and then turned the other way, which is really what we want to use this indicator for. So this indicator perhaps not as applicable in this market, and the market that we've had with this extreme volatility is quite unusual. So I think we perhaps put a little less weight in the bullish percent index setup at the moment. The VIX, which is the fear index, people buying put options to protect their stock portfolios. You can see that has started to. We did get a breakout of this wedge, moved up initially, and then has really started to fall in the last few days. And really, this is what needed to happen. We needed to get a level of complacency back into the market for us to reach a top and then the decline. So there's a lot of things that are actually coming together very nicely. We've got the US Treasury market perhaps just turning down. We've got the VIX index turning down. They're all things that would be required for us to have a more bullish environment, and therefore the opportunity to perhaps reach a top in the market and then a decline. Copper has continued on its rise, and that's really good for the pure copper stocks, EQN and DML, on Monday, and it's heading up towards the highs at $3.65. So a break above that would see copper push on quite a bit further. One of the reasons for this is that copper inventories have been falling all year. May well be we're just getting a little bit of stability now around about this 400,000 ton mark, but you can see it's dropped about it's dropped nearly 33%, which is quite substantial. We'll have a look at the gold chart when I go on to Market Analyst, and crude oil is basically in this band here between 71 and 76. The bigger picture trend is down, and I think there's a possibility we could head down into the low $60 area. So we'll come back to the strategy for September. We'll just go and have a look at a few charts. And first of all, the S&P 500, and as you can see, we had this little triple bounce in a very close succession off this 1040 area, which had been established from the February lows and from the May lows. And we've also got this downtrending line here from the peak in April to the short-term top we had in early August. So very strong run each of these days, quite sizable in range, closing on their highs, so really quite a definite move there. So it will be interesting to see whether the US market can push up above this trending line. I suspect that with the momentum there at the moment it may do, and could push up into this 1110, 1120, perhaps even 1130 area and form a double top, or maybe even a slight overrun here, perhaps up towards 1140. That would be the area that I would be expecting, given all the analysis that I'm looking at the moment. That would be as far as the market runs. If the market then progressed on beyond 1140, then I would have to say that my assessment is not panning out, or the market is doing something different to the overwhelming indications, which are that we're heading lower. And at that point, we'll just have to acknowledge that's the case and change our position and move to the upside. But in any case, we're participating in this rally at the moment in the Australian stocks, and we'll continue to do so for probably a few days, perhaps even a week longer. So that's the S&P. Let's have a look at the local ASX 200, and Similar kind of pattern. We've got a resistance area here, which is just about 45.80 at the moment. I would expect that our market will go very close to that, breaking that on Monday, given the way the futures were on Friday night, and probably push beyond it. So I think there's a fairly reasonable chance now that we're going to push up into this 46 to 4700 area, which to me would be